don't you bring your panel on up?
I love it. Thank you.
All right,
Appreciate
thanks.
it.
Good luck.
All right, panel.
All right, everybody.
We've got Andrew Cushman, David Moghavem, and Rob Beardsley. Guys, come up. There you go. How are you, man? There we go. Hey, how's it going? Oh, good. Awesome. Good to see you. Good job. All right. Well, let's jump into it. First and foremost, hope you all are enjoying everything. That snow yesterday was crazy because I'm in Cincinnati and we had this deep freeze. So when it finally melted, I was like, awesome, done with this snow crap. Get out here, man. It just snows all day. So hopefully you guys are enjoying yourself.
You got to come to Miami.
Yeah, man, I got to do something there.
Yeah.
David, I actually want to start with you, right? We've heard all these guys talk about multifamily investing and what's going on. From your perspective, how are you evaluating deals in 2026?
Yeah, well, thanks for having me, and it's an honor to be on the stage with you both. So, a little bit first about Trion Properties really quickly. We're owner-operators of value-add multifamily across the nation, and our North Star historically has always been untrended yield on cost. So what a property can become after you snap your fingers and get to the pro forma rents that you think you can achieve over the cost of the whole project. So not just purchase price, but construction costs, renovation costs, financing costs, fees, everything, fully loaded. What's interesting post-rate hike is that yield on cost can be even lower than your going in cap rate. There's gain to lease, right? Instead of loss to lease, there's rents are going down. There's deferred maintenance costs that your purchase price is not accounting for. And so as before, you would think, okay, you're buying something at a 3 cap, but it could be a 6 return on cost. Now it's, hey, you might be buying something at a 6 cap, but it's really a day one yield net of gain to lease, net of deferred, sub 5 potentially. So how are we evaluating deals today? We're looking at it based on conservative gain to lease, net of deferred yield that ultimately it can become. And if the deal still works and still stands on its own 2 feet, then we feel good about it.
I love it, folks. No, untrended yield on cost.
Yeah, because trended is with rent growth.
Yep.
Trended is with expectations of inflation. But I think that's something you can only control what you can control. And so that's where the untrended basis comes from.
And you're investing across like 9 different markets, right?
Yeah, we're in 8 different states: California, Oregon, Colorado, Texas, Florida, Georgia, and Carolinas.
All right, so you're seeing a lot. Rob, you are primarily focused on Texas. And I know for a lot of people, when we talk about multifamily investing, many people only really hear Texas investing. So talk to us about the state of Texas multifamily.
Sure. And first off, hey everyone, my name is Rob Beardsley. I'm the founder and CEO of LSCRE. Since 2018, we've acquired about $1 billion in multifamily assets in Texas. We're vertically integrated like you guys at Trion. And we also have no investor losses or capital calls. So in Texas, there's been a whole lot of activity. There was a ton of interest in the Texas multifamily market in the run-up in the low interest rate environment. If we were at this conference a few years ago, you probably bumped into 1 million people that were investing in Texas, that wanted to invest in Texas. And that's a good thing. It's a liquid market, and there's a reason for it. The demand and the drivers there are very strong. So Dallas and Houston are pretty much always at the top of the country list in terms of population growth and job growth. And that gets investors very excited. However, it's true in Texas and it's true almost everywhere. Demand can always be outstripped by supply. Developers can build new product faster than people can move to the area and jobs can get, spinned up. So that's been a big challenge in Texas as well as across the Sun Belt. So experiencing that oversupply, in particular pockets especially, is where that gain to lease, where those concessions, where your numbers get upside down. And so we've been really focused on those higher barrier to entry submarkets because yes, you could paint, for example, Houston with a broad brush and say, oh, Houston, there's no zoning and it's land forever, it's easy to build in. You can absolutely paint the market with a broad brush like that, but we all know that markets are not that way. Markets, doesn't matter where you are, they're block by block, they're neighborhood by neighborhood. And so even within the markets that we're in, like Dallas, Houston, San Antonio, there are those pockets where there are local municipalities averse to supply. There's geographic barriers, there's economic barriers, and things like that.
Yeah, lots of great things there with Texas, and you talked about supply a little bit. Supply is certainly one of the key factors that have impacted multifamily over the last couple of years. How are you all seeing supply impact you and your markets? Let's start with Andrew.
Yeah, it's been really Andrew Cushman, founder of Vantage Point Acquisitions. We started in 2011. You guys hear me?
Yeah,
Great.
okay.
We started in 2011. I live in Southern California, so I'm disappointed I can't be in my shorts and flip-flops right now. But all of our investments are in the Southeast U.S., so Florida Panhandle, Georgia, Carolinas. And like Rob, we've been very fortunate. No capital calls, no losses. We have no distressed assets, and we're gearing up to take advantage of the opportunity that's coming. To get to your question, it's been very clear to us, comparing the different markets that we're in, that supply is probably, at least right now, a even much bigger factor than interest rates in the economy and everything else. So, for example, we own a property in Valdosta, Georgia. Just curious, anyone heard of Valdosta, Georgia? All right.
Wow. A
couple, right? So, for those of you who haven't heard of it, it's a little town, perfectly equidistant between Orlando and Atlanta, right on the freeway. For every quarter of the last 3 years on that property, we have set new records for revenue and NOI because there are zero deliveries in that market. And it's a blue-collar workforce housing town. Same thing with our property in Grovetown, which is a suburb of Augusta, Georgia. Same thing with our property in Lynn Haven, Florida, which is the Panama City Beach area. On the flip side of that, we have a handful of properties that are in demographically very strong suburbs about 45 minutes outside of Atlanta. We thought, hey, we'll be pretty insulated from the oversupply that we saw coming in Atlanta. We were wrong. So much supply hit Atlanta, and rents got hit so hard in Atlanta, really on the concession side. When you're offering 1 month free rent, that's an 8.3% decrease in revenue for each lease that you do that for, which effectively is a rent decrease. So even though we're in great markets 45 minutes outside of town, the downdraft created by all that supply in Atlanta flattened those suburbs. And we saw in several properties just no rent increases. And then in a couple of properties, we actually had to drop rents a little bit. We're still in the low 90s, so it's not terrible. But it was very, very clear that the number one factor for us was, how much new supply. And that whole thing you hear about, don't worry about it. I've got a B-class property. This is luxury A-class stuff. That is a lie. Because when that luxury A-class stuff is offering 3 months free rent, someone looks at your B-plus or your B-minus and even your C and says, well, forget it. I'm just going to go live in this brand new one for a couple of months and I'll worry about it later. And then everyone in Class B loses their residence to Class A, and then what does Class B do? They go poach from Class C, and brokers in particular won't issue the D word, but then the people in Class D move up to Class C, so C and D really gets hit hard. So it filters down. It's called the filtering effect. So
I think it's one of the things we have to understand, right? When I'm listening to you guys talk about it, what you're really getting at is the fact that all real estate is local. Right, when we talk about multifamily investing, you could be in one market and crush it. You could be in another market and have these kind of challenges despite understanding all the data, recognizing that, hey, we've got great demand, this is a nice area. There's so many things from a local perspective that impact demand and impact the ability to push rents that you really need to understand that. All three of you guys invest out of your backyard. How do you guys understand the local market and get that data, and what are you paying attention to make sure you understand what you should be investing in? I'll start with you, Andrew.
So we started remote. My philosophy is live where you love to live. I like to surf and snow ski, so Southern California, and then invest where the returns are the best. So back in 2010, we picked Georgia in the Southeast, and our goal is to be an inch wide and a mile deep, so we've been in that market ever since. When I started, in order to invest outside my backyard, I made frequent trips out there. Probably every month, every 2 months, I was spending a week or two traveling around, looking at markets, looking at properties, meeting people. And so that's how it starts in the beginning. Then, and I also partnered with, did a whole big interview process that I won't go through, but partnered with a regional property management company that I could allow me to integrate myself into them. So it's not truly third party. It's actually, we have a hybrid model. And so we had their boots on the ground, and then now as we've grown, we've done about 3,000 units. I have local asset managers. Our acquisitions team lives there, so we started out. I went out there and then just built a local team over time, and then by picking an area that still has some ups and downs, but has the right long-term, like multi-decade demographics, it allows us to stay in that market through different cycles, learn how those markets perform, and get really, really good at those markets. Like, you can send me a property in Atlanta, I can guarantee you there's no property that will come up for sale that we haven't already looked at 2 or 3 times. And like, oh, it's on that street, forget it, right? So
I love it. Let's skip you, David. I'm come back to you. Let's go to Rob.
Sure. I mean, if you're investing not in your backyard, you got to make it your backyard. There's no shortcut. So kind of the things Andrew said, you have to make it your expertise. You have to really enjoy your craft. And for us, it looks like frequent trips, having local boots on the ground. We have an amazing partner, Sam Morris, on the team, who's born and raised in Houston. So he knows all the tricks of the trade and all the right and wrong streets and things like that you really can't Google and find online. With that being said, though, there are a ton of things online these days. This is not the 90s. There's a ton of information that you can do to get, I would say, 80, 90% of the way there. So, and that's not rocket science. All of us in this room know how to analyze, income and growth and crime and school data and stuff like that. So I wouldn't say it's the most challenging thing to become, I don't want to say expert, obviously, but to understand whether it's a good location or a bad location. The more challenging thing is differentiating yourself in that market. Because if you're not in that market, if you're not taking the brokers golfing, if you are not building the local presence where the multifamily industry, the leasing agents, the maintenance teams, the managers, if they're not dying to work for your company and you're not building that sort of loyalty, you're going to get eaten alive by turnover at the employee level, which trickles down to the tenant level. So, and also it doesn't hurt that I spent 6 months living at one of our properties in 2024.
I love it. So David, you're across multiple markets. So for you, this might be a little more challenging. How do you manage kind of understanding that local market knowledge?
No, I love the analogy of making the market like your backyard, and both Andrew and Rob have said it so eloquently. It's a lot of trips, it's a lot of travel, it's hiring the right people, boots on the ground. For us, being vertically integrated, like talent on the ground is everything. And property managers is probably the most thankless job in our industry, but it's the most important. And we really, we spend thousands of dollars with recruiters to hire our on-sites, our maintenance techs, our regionals, and that's really like, these business plans, they hang on a very thin thread that can break if you have the wrong boots on the ground. And so the trips, talking to the brokers, the relationships, this is a relationship business. I'm on a flight on average like over one flight a week at this point. It's crazy with the conferences and talking to brokers, but point being, that's what it takes to get done. And what Andrew said was also important, leaving no stone unturned in terms of what deal you're underwriting. For us, when we break into a market, I think it takes us over a year at this point for every market we break into, because we're taking that first year underwriting every single deal. Our goal is to try to find alpha in a market and to find asymmetric returns. So first we need to say, what's market? What are the returns in this market? And it's our job to figure out, all right, what's market and where can we play to find asymmetric returns? So as Andrew said, that's how it's done, leaving no stone unturned.
I love it. You have been vertically integrated in your properties across these different states. And obviously we know that property management is one of the most thankless jobs and the least profitable elements of this business. Yet you are getting into third-party management now.
Yeah.
Why?
People think we're crazy. So we're in markets that a lot of these 500-pound gorillas, the Greystars, the AMCs, the Asset Livings, they're being snobbish right now. They see a 70s vintage deal that's 80% occupied and operationally distressed, and they're like, I'm not touching that. I'm not wasting my time with that. We own a lot of properties in that vintage, and we're outperforming our comps. we learned the hard way on some of these issues, and we've beefed up our staff tremendously. Like our talent, again, we've not just boots on the ground, but even on the back office. And so what we're doing now is we are looking at properties that are operationally distressed in our comp set, and we're saying, hey, let's manage for you. And you'll be surprised how many people are willing to work with us because we have an ownership lens for that type of asset. And so we're not just coming in and saying, hey, we'll maintain occupancy and this, that. No, we're finding solutions to their backdoor eviction problem. We're finding solutions to their concession problem. We're finding out ways for fraud detection tools. And so these are points that most of these bigger, I don't want to talk smack about these bigger property management firms.
It's justified.
Yeah. Okay. So anyone in our industry knows that like no one will care more than you as an owner. And I feel like what we do as a strategy, I could talk about this for hours, but point being, we kind of partner also with these owners and managing and finding solutions.
God bless you, man. Third-party managing Class C sounds about as much fun as nude beekeeping.
Yeah.
David, to that point, I hear that, and that makes sense, and that sounds great. But to do that, to make 3.5%, and then your margins have to be super slim on something like that. So I'm going back to why. Are you partnering with them and getting some upside? Like, I'm having a hard time figuring out why somebody would sign up for this.
We get creative. Okay. Again, these are properties that are sometimes in our comp set or in our MSA. They're properties that we've underwritten when the previous owner bought it 3 or 4 years ago, so we know the asset well. And here we are 3-4 years later, rate hikes, operational distress, and we're saying, hey, we know how to manage this, and maybe there's something down the line that we could partner in.
Okay, love it. Andrew, you mentioned your hybrid model earlier, which, man, that's a creative approach. If you can figure out a way to work with an existing property management company, but you step in and insert yourself as the asset manager, that alleviates a lot of those issues. How are you able to identify the right property management company to implement this business plan?
Yeah, the ones that David mentioned won't do it, right? So you're not going to go to an Asset Living or a Greystar or any of these big guys because, like you said, they're going to be like, no. Or they're going to be like, okay, you're the owner, we send you a report, and you just read that. So what we did is, so again, this is going back to especially if you're making a market your backyard, great analogy, is every broker we talked to, every lender we talked to, we said, hey, if you were buying this, who would you hire to manage it? We built a list, researched them, narrowed it down to like 5. Did some phone interviews, narrowed it down to 2. I flew to Atlanta and had lengthy dinners with the owners of those 2 companies. So that's key right there. It has to be a small enough company that you can meet with the owners, but big enough that they have a strong presence in the market and have some leverage with vendors, suppliers, and if your manager gets sick or quits, and they can pull someone and fill that spot temporarily, right? There's a lot of advantages to working with a group that has some size. At the time, the management company we partnered with managed 3,000 units in the exact same geographical area that we were in. And we had a conversation over dinner, like, hey, if we hire you, this is how we're going to work. We're going to run the weekly calls. Our asset managers are going to do that. We're going to provide the direction. And in a very nice way, I don't have time to explain now, we basically said, you're going to do all the paperwork and the evictions and the not fun stuff that we don't want to do, the admin, and we're going to drive the bus. And we found a group that agreed to it because they saw us as a partner to grow with, and they've been our partners now for 15 years. And it's worked exceptionally well for us. It's a long game, but if you find the right group, it is definitely a big lever you can pull to make out of your physical backyard investing work.
I love it. We're going to start taking questions, so if you do have questions, Kennedy and Amy are here and here. Just come up to them and they will find you, and we'll get into those questions. Rob, one of the things that we were talking about before is just how you've adjusted your investing strategy. We heard Jay Scott earlier talk about, hey, he would focus on value add deals right now. You've got a different take. What's that?
Yeah, I love that everyone sees the market differently and there's many ways to make money. From our perspective, we feel like it's very difficult to be successful with value add when you're swimming against the tide. So you really need a rising market when rents are going up and occupancy is going up to make the value add easier. So when you're coming in there and spending money on unit renovations, it's not in vain, and you're actually getting those rent increases that you hoped for. And right now, if you look at a lot of deals right now, I call them failed value adds. So the seller or the owner is trying to sell them, and the broker package will say that it's a value add opportunity. You can finish what the owner started, and basically the ownership took 20% of the units or something and renovated them and are proving out some sort of increase. But if you really analyze the rent roll, you'll see that the vacancy is clustered in those renovated units. You'll see that there's loss to lease on those, so they're really not getting the true bump that they're advertising. So if you look at it from that perspective and then base that against the actual cost to renovate, which has only gone up over time, your ROI is not there. And then that's nothing to say also about the time and risk associated, right? It's going to take time and a lot of effort. It's a lot of work to do value add. Anyone who's done that and managed a renovation project, it's a big project. So we like the option of actually buying core plus assets in today's environment. We think that the basis is strong today, and where we are in the cycle is advantageous, that we're going to ride up with the market. And so I feel like one of the misconceptions of the previous market cycle was that buying value add multifamily was a great investment. And it was. I'm not saying it wasn't. It's just, was it the value add that made it the great investment, or was it the market cycle that drove all values up? It was almost like the junkier the property you bought, the worse location you bought,
The more excited you got.
the more it appreciated, the more it did well, right? It was a perverse market. Now we've unwound that. And I'm not saying the market won't get crazy again. It will. But in today's market, we're in a sane situation where A's are 4 caps, to just overgeneralize. B's are 5 caps and C's are 6 caps, right? It wasn't that way. There was no dispersion before. Everything was a 2 cap. So now in this environment, you can really actually differentiate yourself, buy in those very high quality assets. We're not afraid of even Class C properties, but we will not touch Class C locations. That's where we don't think the risk is worth the reward.
I want to add something there. So I think it's important to define some of these. I agree with Rob. This is the lowest ROI market we've ever seen in terms of getting a unit, turning it, and trying to bank on a rent bump to justify your NOI. We're seeing none of that. In fact, we're seeing NOI kind of go down. But there is a capital dislocation we're seeing right now, where if a property doesn't check every single box, you're getting a widening of yield beyond the risk that you're taking in some cases. And so where we like to play is kind of this sub-institutional, where it's not a Class C, but it might not be the Class A that checks every box, because the capital flows that are chasing that Class A is really compressing yields to a level where it's hard to compete and get to your return. So we like the sub-institutional, maybe a 90s or early 2000s. Maybe there's institutional owners in the comp set that this pocket used to be institutional, but for whatever reason, they're going to the shinier new property. And if we're comfortable with the cash flow today, worst case scenario, you're coupon clipping and it's standing on its own 2 feet. Best case scenario, you get some cap rate compression if the market starts to rebound, and that becomes an institutionally qualified asset to buy.
Can I add something about Class C? So many of us in this room got started in Class C. I did myself as well. There's going to be some great opportunities, especially to get an incredibly low basis coming in Class C, but keep in mind that Class C always looks way better on a spreadsheet than it does in real life. You buy a distressed Class C, you are basically taking on the same job as the guy who empties porta potties, right? You're dealing with crap all day long. That's all it is. Now, if you're willing and able to do that, you can make a ton of money. But my advice to people getting started or kind of in the mid-level area is, if you get a choice, or our business model now is, if we have a choice between a Class C and a Class B and all other things are basically equal, we would go with Class B all day long. When I look back at the last 3,000 units that we've done over the last 15 years, our Class B stuff not only had better returns, but had it with less risk and less headache. So keep that in mind when you're looking at two spreadsheets and one's Class B, one's Class C, and you're like, oh, this one's only 80 a door and this one's 120. What I like to say is the grass is always greener over the septic tank. So.
I love it. Do we have any questions? I don't know where Kennedy and Amy are.
I've heard two strategies. Andrew, you've mentioned you go out and get a third-party property management group to manage all of your properties. And as we all know, property management is key to making these things fly. David, you're more on the area where nobody manages a property like the owner of a management. Do you see conflicts with owning and managing your property versus going out and third-party hiring somebody that's an expert in property management?
Expert.
So the question is, to rephrase, is getting a third-party manager to manage our portfolio versus, or us managing someone's property?
The question is do you see a conflict in self-managing versus hiring a third-party manager to come in and manage your assets?
Do you want to go first?
Yeah, I'll say, I don't know if there's necessarily a conflict. I would keep in mind also that caring doesn't always equal competence, right? If I take my son to the doctor and they're like, hey, bad news, good news, he's got a brain tumor, but we can get it out and it's benign, we just need to do the surgery. And then we schedule it. I'm not going to walk into the OR that day and be like, hey, doc, I care about him more than you. Let me do this, right? That's not a good idea. And candidly, when we're looking for acquisitions, we love self-managed properties because there's a lot of them that are very poorly managed. With that said, self-management makes sense if you can build the team and the systems to do it right, because then you pair caring with competence. You have to have both in order for it to work, and that's where it can go wrong, is if you don't have both of those. These guys have both. That's why it works. There's a lot of other people in this room that have both, and it works. So there's not necessarily, I don't see a conflict. And then where conflict happens going on the other end of the spectrum is if you hire third-party property management and they are not aligned with your goals or how you operate, that's where conflict comes into place. And I'll give you a real-world example. I've bumped into this even with our long-term partner, right? Like a new regional come in. The property management world has a mentality of we want to present everything nice and positive to the owners. Like everything's going great. Don't look behind the curtain. It's all fine. And so we've caught a couple of times where a manager or a regional will be instructing the property manager, hey, talk to me first before you talk directly to the owners. And we're like, you will get fired if you do that, right? So there can be some conflict, but there's ways to eliminate it. So.
Yeah, I agree that the alignment is different with a third party where they don't want to lose your business as a third party manager. So they'll just make sure that everything is fine and rosy, and they're looking at the financials differently too. Like we're looking at it from an owner lens. So it's not just about occupancy. It's not just about there's more to it. It's maybe getting rents and capturing loss to lease if rents are going up, or maybe it's solving a backdoor eviction issue. And so it's not about just maintaining, ramping up occupancy if it's bad credit tenants. So I think self-managing, there's a little bit more of an alignment there.
I will add that many property management companies are good at one thing and not the entire suite of driving value. We had a third-party management company. They were excellent at pushing rents. I mean, they pushed rents way further than I would have been comfortable with. They also put in tenants who were less than savory, and within 60 days, we were evicting some of these people. And guess what? The way our agreement was set up, they got paid twice because they were taking that first month's rent with leasing. So you go back to that alignment of interest where if you don't get paid when I get paid, we're not looking at the business the same way. So they don't really care because they're going to refresh that. Now, we had to sit down and talk to them to say, this won't happen again. If you guys, someone moves out because they didn't pay rent, we're not paying you. You're on the hook for that. But you have to align that interest because that can be really challenging.
Can I add two quick things? So we haven't done this, but I know people who have. If you're using third party and you want alignment and you structure your operating documents well, you can give them a small piece of equity interest or economic interest in the property so that if it does really well, both annually and when you sell it, they benefit as well. That helps with alignment. And then what sometimes get lost in the third party versus self-management is the most important piece of this is the the property manager who sits there and runs the asset day to day. They have a bigger impact than any of the rest of this stuff that we are talking about. Don't make the mistake of buying a $5, $10, $50 million asset and then trying to hire the cheapest property manager to sit there. That is the one place where you want to overspend, and a great property manager can turn a so-so deal into a good one, and a bad property manager, I'm talking, again, the person sitting in the office every day, can take the most amazingly underwritten, the best basis, the best deal you've ever seen, and run it into the ground. So that is the key person in all of this.
Love it.
Thanks for sharing those stories, guys. A quick question in terms of avoiding capital calls and distressed deals over the last couple of years. Is there anything that you guys have done creatively to avoid that, or is it just the nature of the original basis you got in at and the debt?
Not sleep. Work really, really hard, and I think it's a show of, not to break our arms patting our backs here, but I think it's a show of character, because in good times your investors make money, you make money, and it's great. And then in bad times, are you showing up every day working just as hard, if not twice as hard, for no compensation, deferring your fees? There's no promote waiting for you at the end of the tunnel, and you're just still grinding every day to try to fight whatever challenges you have in terms of supply or evictions or what have you. So yeah, I don't think there's any sort of magic. I'd love to hear if you guys have some magic.
No, I mean, as you said ways that we got creative. Yeah, deferring fees, being, signing things that you probably wouldn't want to normally sign, but for the benefit of the deal, you should sign. We've definitely gotten very creative, and it's just a testament to when shit hits the fan, who are you as a person? Are you going to be the one that just lets go? Or are you going to work your ass off to make sure that you can see this project through and deliver to your promise and your fiduciary duty as an operator?
So for us, there's a couple of things, but probably the number one, patience. There were times in the last 5 years we went 18 months without buying a deal. But the biggest one that saved our butts is we did not see this coming either. I mean, we didn't think, the Fed's going to jack rates 525 basis points and just put a stick in the spokes of the wheel of the market. But what we did, and we always do, that saved us is we think probabilistically, meaning we don't bet our investment on a single outcome or a single case. So I'll give you an example. We bought a property, $48 million acquisition in Florida, March of 21, we closed it, so pretty close to the peak. We got offered floating rate debt at 2.5 or 12-year Fannie Mae fixed rate debt at 3.79. At the time, everyone thought we were crazy to not go with the 2.5. That's so much more money you're paying in interest. We said, we're going to we can get a 12-year loan, 7 years interest only. Let's look at what is the most probable outcome. Right now, today, 21, interest rates are at the lowest they've been in 30 or 40 years. Probabilistically, will they be higher or lower 5 years from now? Well, if they're at an all-time low, there's a good chance they're going to be higher. All right. Well, what if they're higher? And if we fix the loan and they're higher, what happens? Well, then we're paying less interest because we fixed it and we have a 12-year runway. Well, that's pretty good. What's the worst case outcome when we're wrong? All right. Let's say 5 years from now rates are actually lower, which we didn't think would be likely, but possible. All right. Well, we fixed our loan at 3.79. Rates are lower. That means our yield maintenance would be higher if we sold it, but that means cap rates would probably be lower. Right. That properties would be worth a lot more, and so that would probably counteract any downside of fixing. Therefore, we should fix this loan. It was black and white and clear. Today, that property still distributes double digits cash on cash. It has since the day we bought it, partially because it's a great asset in a great market, but the biggest piece is we are still sitting on interest-only 3.79% loan. We didn't know this was coming. We just looked at it probabilistically. And that's how any investment should be evaluated. Not, this is what's going to happen, but this is the base case. What if this? What if this? Look at it like a bell curve and make sure that you hedge against those tail outcomes that could take you out of the business.
The one other thing I would add to that is to continually look at what's happening. I think too many people were just being optimistic and hoping things would go back to how they were, and they didn't react fast enough. Because that's great if you can get the loan, but once you have that bridge loan, you have that bridge loan. You got to just react. Yeah. And not enough people are taking precautionary steps early enough in the process, maybe halting distributions early enough, putting more money in reserves, doing whatever you needed to do to protect the asset. And that's your number one job. Protect the asset, then you take care of your investors. But a lot of people chose to keep the facade of a deal that's going great, even though they were burning through money. With that said, we are out of time. I want to thank our wonderful panelists here for your time today. I know most of us will be around, so thank you for your time today.
Great.
Give it up for our great panel. Thank